Hi guys, welcome to my channel. Today let me ask you a question. If an individual wants to analyze or evaluate his financial condition or position based on his cash flow, his net worth, his financial statements, his liabilities, what is the way to do that? How can he analyze? Well, the financial condition of an individual can be analyzed by knowing about 7 financial ratios. So here in this video, we are going to talk about 7 financial ratios which every individual should know. So let's begin. The first ratio is liquidity ratio. Well, liquidity ratio is an indicator of a person's ability to meet his or her expenses in case of emergency or in case of some unwanted, unforeseen situations. In other words, it shows that how many months your money will last if all your income sources come to an end unexpectedly. So the formula to take out liquidity ratio is your total cash divided by the monthly expense. Well, your cash will include everything in your savings account, everything in your current account, everything in your fixed deposits, or everything in your liquid mutual funds. And your expenses, monthly expenses means your both discretionary as well as undiscretionary expenses. Let's take out an example of Mr. K. Let's suppose Mr. K has 15,000 cash in hand at home and 15,000 in his savings account and 30,000 he has in his fixed deposits. And his monthly expense is coming out to be 15,000. So you have to add all the cash reserves of Mr. K divided by his monthly expense. What comes out will be the liquidity ratio of Mr. K. Now, a question may arise. What is the ideal liquidity ratio? Well, anything between 6 to 12 is considered to be an ideal liquidity ratio, but the liquidity ratio will also change with the person's profession and the person's age. So you are your own judge that what is your monthly expense. So according to that, you should be able to manage your emergency fund or your contingency fund so that you have a good liquidity ratio. The second ratio on the list is savings ratio. Well, savings ratio indicates that how much money should be kept aside as saving in a person's life. When it comes to savings ratio, it can be calculated by dividing your total savings by your gross income. When it comes to total savings, it includes savings from all your investment vehicles and your cash reserves. And when it comes to gross income is your earning from salary, your earning from rent, your earning from dividends, your earning from any other kind of royalty and all other sources of income. Now, to understand this, let's again take the example of Mr. K. Well, Mr. K, let's suppose he has 20 lakhs in his mutual funds, PPF, altogether he has some 20 lakhs of rupees. And his gross income is 5 lakhs. So his saving ratio comes out to be 20 lakh divided by 5 lakh, that's 4. Now there may arise a question, what is the ideal savings ratio or what is the ideal figure of savings ratio? Well, it may depend on whether you are starting with your career or whether you are a middle-aged person or whether you are nearing your old age. But anything above 5 will be considered a very good savings ratio. So that means you will be able to save more or you have to save more from your salary and park it in different investment vehicles. Now moving to the third ratio on the list, it is known as debt to asset ratio. Well, debt to asset ratio helps people understand few things. That is number 1, have you overborrowed out of your limit or out of your capacity? Number 2, are you in an uncomfortable situation of facing solvency issues? Your debt to asset ratio should come into play while deciding to take a new loan. If you feel that you have already overborrowed beyond your limit or you already have multiple loans running, then it would be advisable not to go for a new loan. Well, I believe, in my opinion, the right thing is that you square off all your existing loans and then go for a new loan. Now, debt to asset ratio can be calculated by dividing your total liabilities with your total assets. Now, when it comes to your liabilities are like your car loan, home loan, personal loan, any credit card loan, any money that you have taken from a private money lender or a friend for that matter of fact. And when it comes to your total assets, it includes all your liquid assets plus everything that you have invested plus everything that you have in material, that is your car, home, etc. In my opinion, the ideal debt to asset ratio should not be beyond 40%. I mean, you should never ever go take a loan of more than 40% of your total assets. That would be an ideal debt to asset ratio. The fourth ratio on the list is debt servicing ratio. Well, in today's time, we buy everything on debt. Either we buy things on credit cards or we buy things on post-dated checks. But I do believe that we need to control our debts. And how to control our debts? Debt servicing ratio is a very important parameter to judge that. Debt servicing ratio measures your debt obligation against your monthly income. That means if you have to calculate debt servicing ratio, you have to divide your monthly EMI, total monthly EMI, by your total monthly income. Though many of the experts say that your debt servicing ratio should be maximum 30%, but in my opinion, I would say that your debt servicing ratio should not be more than 20 to 25%. That means you should never buy things on credit which takes away more than 25% of your salary. That is illogical actually. But when we talk about youngsters and people living in urban areas, their debt servicing ratios have touched dangerous levels. They are under a heavy loan or they are under a heavy burden of paying huge EMIs. So everything that they are earning in a month is being washed away by the EMIs. So be sensible, understand your debt servicing ratio and then go for purchasing things on credit or on loan. That's because, my dear friends, when you start earning, your primary objective in life should be to move from a high debt and low saving to no debt and high saving. The fifth ratio on the list is inflation hedge ratio. Well, inflation hedging is a strategy which provides protection to your money in case of inflation and in case when your currency plummets. As a part of inflation hedging, you need to choose your investment assets which give you more return on investment as compared to the rate of inflation. For example, money parked in fixed deposits can be considered a very safe investment. But the return on investment in an FD is usually 6 to 7%. And when you consider it with the rate of inflation, you will understand that over the years, your money parked in an FD is losing its buying power. So what needs to be done is you need to hedge inflation. And as a part of it, you need to choose investment assets such as equities, mutual funds, index funds, or in my opinion, you can even go for commercial property. Having said that, your inflation hedging ratio or the money that you are parking in inflation hedging assets also depends on your age, your business, your work, and most importantly, your risk-taking appetite. So be wise in choosing your investment vehicles. Well, dear friends, the last ratio on the list is life insurance coverage ratio. This ratio indicates if you have adequate amount of life insurance cover or not. Now, the formula to calculate life insurance coverage ratio is you have to add your net worth and your existing life cover and divide it by your post-tax salary. Now, let me make you understand that the net worth means your total assets minus your total liabilities. Let's understand this with an example. And for that, how can we forget Mr. K? Let's take an example of him. Let's suppose Mr. K has 50 lakh assets and he has 25 lakhs of liabilities. So his net worth comes out to be 50 minus 25 lakhs. Let's suppose he also has an additional life cover of 30 lakhs and his monthly salary is 5 lakhs. So you have to add 25 lakhs plus 30 lakhs divided by 5 and the ratio comes out to be 11. So the figure of ratio 11 means that Mr. K has provided 11 years of expenses for his family. That means if tomorrow something happens to him, his family will be able to survive for 11 more years and take up 11 more years of expenses with this current ratio, as per this current ratio. One thing we need to understand here is that this ratio does not consider the inflation rate. So the number of years the family can survive may come down when we start considering the inflation rate also. That's the end of the video, guys. I hope you are liking the content that we are posting, and if you are liking it, please press the like button and share it with your family and friends. Thank you, goodbye, and God bless you.